2024 has been a big year for global markets, and this week and the next week will probably be the two final big weeks of the year. So hi there everyone, welcome to the Traders Circle Weekly Market Update. Today is Tuesday the 10th of December 2024. Yes, it is almost Christmas, but before I get started, you do need to be aware that whatever I say is general advice only, and you have to consider whether it's appropriate for you. So today we had the final Reserve Bank of Australia board meeting for the year. The Reserve Bank understandably left interest rates unchanged, as they have done for quite a while now. They did, however, change the accompanying statement. They included the line that the board is gaining more confidence in inflation getting back into the target range. And that was seen as quite a dovish change. In recent times, the board has said they're not ruling anything in or out, essentially saying they could lift rates further, they may cut rates, they're going to see what the data suggests. In this statement, they basically said that, inflation, they see inflation as coming back into the target range. And so, it starts to conjure images that, maybe we will see a rate cut in the coming meetings. Most market watchers had assumed that the rate cut would come at the May meeting. And that was because the RBA previously said they wanted to see two readings that suggested inflation is coming under control. However, I did watch Michelle Bullock, the RBA governor's press conference after the statement, and she said that these readings don't necessarily have to be quarterly or even monthly inflation readings. They could actually be other economic readings, such as GDP growth or unemployment, things that do suggest that the economy is weakening. I would just caveat that by saying that we have seen plenty of data that suggests the Australian economy is weakening, and yet, they still obviously haven't cut rates, but they're still not that close to cutting rates, and that is because the inflation data is still strong. So even though she sort of alluded to the fact that, other data readings will come into account, they still do need to see more progress made on underlying inflation. Underlying inflation in Australia hasn't really fallen for a few months. And inflation in the US and other parts of the Western world also is remaining quite sticky. So even though Michelle Bullock alluded to the fact that other readings could influence it, and that means that it might not be May next year, that means they could look at February, I still think it's unlikely unless we see quite a deterioration in non-inflationary data. At the same time as well, they don't want to get into a stagflationary scenario, a situation where inflation is still very strong while the economy heads into recession. And I do think that's a real possibility. A lot of the work of central banks this year has been done by the oil price falling. Oil prices have come off quite a lot, and they remain very low. And that's pretty much allowed inflation measures to come down. However, if the oil prices stayed up or picked up, and if we'd seen oil price spikes, we'd be talking a much different story at the moment. Inflation would be a lot stronger than it is, and we'd be quite away from rate cuts. So if we do see oil pop back up, I do think the possibility of stagflation is much, much higher, and I think that the likelihood of near-term rate cuts is much, much lower. Regardless, the statement was definitely seen as a positive for the Australian market. We were down quite strongly ahead of the statement, and we pushed back up after the statement. I think we got down to around 83.60. We pushed back to above 8400 after the statement came out on the XJO, and then we drifted back off a little bit by the close. The other big news for today, or indeed the last 24 hours, is the Chinese stimulus announcements. Now, coming in this morning and reading the headlines, I would have been forgiven for assuming that the Chinese government announced additional stimulus measures. They didn't. In fact, their statements were basically that they would do additional fiscal stimulus next year, and that they would keep monetary stimulus or interest rates very, very low. Basically saying that they're going to do fiscal spending next year. They're going to increase the amount of money that they're providing to the private sector to try and pump the economy up. At the same time, they're going to keep interest rates around very low levels, possibly even lower them further. While that is a very positive statement, it does sort of give the market confidence. Obviously, they've shown a willingness to support the economy, and this statement was seen as basically saying that they're also going to support it if it's weakened by tariffs and things like that. At the same time, it basically was nothing new. The Chinese government has expressed many times and even shown their willingness to support the economy, to pump money into it. And so by saying it again, I don't think it really changes too much. And indeed, obviously late yesterday, we saw iron ore prices pop, but at the time of recording, they'd come back off a bit. And indeed, Chinese markets popped on open today, but they'd come back off a bit by the time of recording. And that is, because the statement really wasn't anything substantial. It didn't include new spending measures. It was just a continued indication of their willingness to provide funding in future. Finally, I wanted to touch on the US. And I think the US data, it's been the big driver of global markets for this year. It was the big driver last week, it will be the big driver this week, and it will be the big driver next week. Late last week, we saw US unemployment data. That came out on Friday night, so US markets reacted to it on Friday, we reacted to it on Monday, and it was pretty much a Goldilocks reading. We saw employment remain fairly strong. We saw, wages remain fairly strong, but not strong enough to deter another rate cut. And so the market's still pricing in a high probability of a US rate cut next week, the final for the year, the third. At the same time, the data wasn't too weak to suggest that the US economy is headed to recession anytime soon. Like I said, jobs created were very strong, stronger than expected perhaps. Wages grew, and perhaps by a little bit more than expected. The only thing that was a little bit disappointing perhaps was there was a drop in participation. So drop in US adults participating in the jobs market. That's not necessarily a sign here or there, but it could be something to watch at the coming readings. And obviously with the drop in participation, it makes the unemployment number look a bit better than it actually is. So with that reading, markets were able to hold their highs. And that's because, they forecast that they will get a rate cut next week. But at the same time, markets are so elevated that even with that data basically coming in about as perfectly as could be hoped, there wasn't really any further upside for US markets. And indeed, overnight, they actually drifted back down. The next most important reading, in fact, probably the most important reading for the last few months, is going to come on Wednesday night Australian time, and that is the US CPI data, the inflation data. I mentioned at the start that Australian underlying inflation hasn't really fallen for a few months. The same is true for US underlying inflation. It's been very sticky for the past sort of 3 or 4 months. Now, they've seen rate cuts in that time, and the market is continuing to price in further rate cuts from there. But, US underlying inflation is still 3.3, 3.4%. And, the US inflation target rate is 2%. So will they really keep cutting rates with inflation, almost double the target range and not coming down anymore? So given that the inflation number is again expected to be in line with the past few months and not come down any further, I don't think markets want to see it at all above expectations. If it is even slightly above expectations, I think there's a big risk for markets, and I think there's a chance that we see next week's rate cut at the Federal Reserve meeting next week not actually happen. To be honest, I think they've started cutting too aggressively and too quickly regardless. And like I said at the start, they've been helped quite dramatically by weakness in the oil price. They do leave themselves open to another spike in inflation if they do go too hard on cutting interest rates. So this inflation reading tomorrow night is going to be hugely important. If it comes in line or lower than expectations, I think we're almost certainly going to see another rate cut next week. Market is pricing in about a 4/5 or 80% probability. However, if that does come in even slightly stronger, those odds are going to shift dramatically, and that could lead to some selling in global share markets. So let's have a look at the charts for this week, guys. And this is the Australian XJO index. We have actually stalled over the past few days. We reached the all-time high right around 8,500 last week. Since then, we've drifted back off a little bit. In fact, in today's session, we actually came down despite a very strong open. Obviously, the strength on opening was due to the Chinese stimulus statements. And we came all the way down to the previous all-time high, right around 83.60. We bounced off that level, and that bounce was helped by the RBA statement today. And then we sort of drifted back off a little bit on the close. That leaves us inside an ascending triangle. We've got resistance up at 8,500. That's the all-time high level. And we've got this rough uptrend line. You can draw it a multitude of ways, but probably coming in, somewhere between 83.50 and 8300. There is a chance we see a further push down back towards that uptrend line, possibly down towards 8300. That's likely to occur if we do see further US selling from here. If the US does see substantial selling on their inflation data coming on Wednesday night, tomorrow night, I think there's a chance that we break that uptrend line. I really do. And, the first target then probably around 8280, 8300, which was the all-time high before the 8360 all-time high. So let's have a look at the US charts for this week. Just one second. And this is a chart of the US S&P 500. They also reached an all-time high over the past sort of week or so, but they actually were a bit stronger than us. They set a series of all-time highs over the past week. They got to about 6,100 on the S&P 500 on Friday with the Goldilocks unemployment data, and they stalled at that level. Overnight, they did show a little bit of a bearish candlestick, and they did it on reasonable volumes as well. It does potentially break the short-term uptrend acceleration, but I would caveat that by saying there's been many bearish candlesticks for the US markets this year, and they haven't always played out into a further bearish movement. Regardless, though, if they do keep falling from here, the first target would be 6,000, which is their own previous all-time high. If they do get a slightly stronger inflation reading on Wednesday night, I think you're starting to look around the longer-term uptrend line, and that could come in somewhere around 59.20 when they do get to that level. Like I said, I think that would probably only occur if they do get that higher inflation number, though. Because if they don't, then the market's pretty convinced we'll see another rate cut next week, the third rate cut, the final one for the year. And that does provide a little bit of optimism for the market going into next year, despite the extremely stretched valuations. So yeah, that will be it for this week. I will wrap it up here. Hopefully you guys enjoyed. If you have a view on whether the inflation is going to come in stronger or weaker than expected, put it in the comment section below. Click the like button, click subscribe, and we'll see you guys next time.